All right, we're still in January. Let's go ahead and book our credit card transactions for the month of January, something that we are familiar with from our food truck simulation. But again, let's go through it. Practice makes it perfect. So, what do we have here? We have some furniture and we have a laptop. Um, three laptops. Okay, so let's go ahead and book that. That would go under enter credit card charges right here. The only question in such situations that come up is we do have the purchase price for each of these items, right? But then we have shipping, handling, and sales tax, and how do we allocate it? Well, some people suggest that it could be expensed. Technically, it should be capitalized and included in the cost of the appropriate item. So in this case, let's go ahead and start booking. So we have online market. Again, mind the date because we're looking for 21. For reference number, we can use transaction number right here. Let's go ahead and copy and paste. Total is 7,866.85. Okay, and let's see, what do we have here? And again, here we're using category expenses instead of items because we're not putting it in inventory, but technically, even though we can use asset account right here. So here it is, right? Again, QuickBooks was built by programmers, not accountants, and again, they did the best they can. Anyway, we have two categories here. We have furniture and equipment, and we have computer equipment. Right? Why do we have that separation instead of just booking it all bulk sum? Well, this reason for separation has to do with the way we depreciate it. Okay, so let's go ahead and allocate the shipping and handling and tax, sales tax to each of the items. So let's go right here. So what do we have? Well, let's see. We have furniture, which adds up to let's do the total for furniture. Yeah, that's our total for furniture, and that's our furniture total for equipment, right? So that should add up to subtotal. All right, it does. And now all we do is we find out what percentage it is. That's how we allocate it, right? It's pretty straightforward. I mean, at this point, at this case, it's about 50%. So, I mean, we could round it. So let's keep it 44 and 56. Okay. So shipping and handling is 346.70 plus 589. Okay. That's our shipping and handling. And therefore, we can go ahead and allocate it right here. Just do this. Get some of them right. Let's round up. And let's do the rest just as a difference. Again, because what happens here quite often is if you are using percentages, you will not come to an even number, and therefore, actually, it will be hard for you to allocate. So let's go ahead and find out our new totals. That's our new totals. Oops. Our furniture right here. And this is our computer equipment. And we should be at the total that we're attempting to allocate, and we are. So again, furniture and equipment would be $3,443.67. $4,423.18 goes to computer equipment. Here in the memo, we can write that we have 3 laptops, and then here we have office. Yeah. So these expenses are not associated with any job. These expenses are not billable. We can go ahead and book it. Before we do, let's go ahead and look at debits and credits, right? So what's happening here? Well, first of all, we know that furniture and equipment and computer equipment are assets, right? So let's go ahead and reflect it here. 15,000 and 16,000 account are assets. Assets go up when debited, and that's what we have here, right? Because again, we have additions to our furniture and equipment and to our computers, so they went up. What else happened? Well, we also have this account, credit card, right? 22,100, and it's a liability, and liability goes up when credited. So what do we have here? We have debits and credits that equal to each other. That's the key. We have to have that. And we have the allocation, right? Liabilities, because we're buying it with the credit card, goes up. And our asset accounts, again, what we're purchasing are assets, they're going up as well. Liabilities up, assets up, because we funded purchase of these assets with liability. So save and new. All right, next one we have purchases of facial tissues, toilet paper, and it all sounds like supplies, right? So again, this one we don't need to break up. So again, it's from Clean Depot. The date is 1/5/2021. All right. This number, let's use the transaction number. In the total, so we will have it for reference. Now, some people would ask me, well, Alex, these are items, right? Why aren't you booking it into the items? Well, the reason we're not booking it into the items in this simulation or for this purposes is because we're not going to track them in inventory. We're just going to expense them right away, right? We're not going to be reselling these items, so there's no reason for us to track it. I mean, we could go ahead and check that inventory from time to time to see if we need to replenish it, but tracking it for the accounting purposes would be, I don't know, a little too much. So again, let's see what supplies account. Supplies, office supplies. To me, this is office supplies easily, right? You could do it as cleaning supplies, but we're not a cleaning business. Reality is we're buying it all as supplies for our office to maintain the office, right? So we're just going to book it there. There's absolutely nothing else to it. All right. In the memo, we can have just again, we can key in something like tissues and soap, right? It doesn't matter. I mean, we can reference that invoice number if we have to. Right? So again, what's happening in terms of debits and credits? So let's go the other way. We purchased it with a credit card. Credit card is a liability. Liabilities go up when credited. Therefore, $305.37 have to be credited. What else is happening? Well, expenses go up because we just expense quite a bit of money on office supplies, and expenses go up when debited. So here it is. Debited. Debits and credits are in balance. We are good to go. Let's save and new. Next one, we have purchases of a monitor, docking station, a laser printer, some paper, and a keyboard. Right, so we have a mix of things, right? Because, and again, what some people ask me, what's the rule of thumb? Well, the rule of thumb is that items that are going to last you more than 1 year, you should probably capitalize unless they're super cheap. So in this instance, I see that the keyboard, and it's arguable, you know, some keyboards do last than more than a year. Keyboards with a mouse for $55 may not last more than a year given professional use. So the chances are probably we're going to book the top 3 items as assets, computer equipment, and then the bottom 2 as office supplies, right? And then we're going to allocate the shipping and handling and sales tax. So let's go ahead and allocate it, right? So we can do our portion there. We have for our computers, it's 1,374 plus 297 plus 698. Now it's arguable that, given how little amount of money it costs, we could expense it in the same year. There are some de minimis rules. In this instance, we're gonna capitalize it just to demonstrate the diversity of booking techniques. But from tax standpoint, technically, we could have expensed it. Again, well, if we have sufficient profit, we could essentially write it off all off as under 179. Anyway, we'll talk about it at the end of the year. For now, again, let's not argue about it. Let's just go the rule of thumb where these items will last us more than a year. We're going to capitalize them, and then the other items on paper and the keyboard with mouse, they probably not going to last us, so we're not going to capitalize them. All right, and this is our sum. So this is our percentage, right here. So let's. And then shipping and handling, right? That's 159.30 plus 270.65, right? So we're going to allocate it. We're going to expense this portion and capitalize this portion. And then let's see, the total would be. Now we gotta make sure that we actually end up at the total that we want to allocate. All right, here we are, and we end up with the total 3,613 that we're trying to allocate. That's good. So those are our two amounts. This is our computer equipment, and this is our expense. So let's go ahead and book this transaction. All right, so it's from online market, the date. Okay, let's use our reference number right here. Okay, here we have computer equipment, 2,688.90. Then their monitor, printer, etc. And then we have office supplies, and that's 925.05. Paper, keyboard. All right, again, everything is allocated, but it has two segments. Again, we allocated the tax and shipping and handling using percentage. That is a question that I'm asked quite often. So what we do is, again, we establish that percentage, right? Very roughly, what percentage each type of type of transaction takes up, and then we take our shipping and handling with sum it, and then we allocate it back to these amounts, and that's what we end up with. So let's take a look at debits and credits behind it. One thing we know for sure, we purchased it with a credit card. Credit card is a liabilities. Liabilities go up when credited. Right, and then we have computer equipment that we purchased with this liability went up 2,688.90. And we have office supplies. Again, debits and credits equal to each other. That's what we were going for. They equal to what we have here on this receipt. Therefore, we did a good job allocating and booking it. So let's go ahead and save in new. And go to the next one. We have some more. This looks like office supplies, very straightforward. Again, we're just opened up our office. We're booking all these transactions, right? So let's go ahead and clear that up and go ahead and book it. So again, it's from online market. For reference number, again, we can continue using this number. Amount is 265.43. And in this case, it's all office supplies, right? No brainer. We can write something like envelopes, writing envelopes. Right, just something memo for us to remember what we purchased. Debits and credits, what's going on, right? So again, we know that our liability went up. Liabilities go up when credited. And we know that office supplies expenses went up, right? Because we purchased all these items, we're expensing them right away. So let's go ahead and increase our expenses. Expenses go up when debited. Here it is. Debits and credits are in balance. That's what we're going for. And therefore, it's good to go, right? Again, expenses go up when debited, liabilities go up when credited. We purchased some drawer file cabinets. Again, we're just setting up the office, so we have a lot of these purchases in January. We have folders and we have hanging organizers. So again, looks like a combination. We have a furniture and supplies. It's a good practice on allocation, right? So let's go ahead and allocate those. Right, so let's do it from scratch, just so that again, people asking, well, I have this, what do I do? Do I expense it? No, technically, you don't expense this portion. You need to allocate it and then in some instances capitalize it. Because technically, whatever it takes to deliver any piece of equipment or furniture to the location and install it, all of those items get capitalized, whatever it takes to bring it to operation. So again, let's break it up. Right, so what do we have? We have $2,574 that's going to go towards equipment, and then we have some supplies. All right, here it is. What do we have for shipping and handling? Here it is, 162.20 plus 275.74. Right, so we need to allocate this amount among this. Need the sum, right, to find out the percentage. Again, it doesn't have to be exactly precise as long as it's approximately correct, right? So again, here we can I don't know, we're gonna round it at the other level. So, and again, there's multiple ways to do it. It doesn't have to equate for penny. IRS is not going to be that kind of demanding, but as long as it's approximately correct. So again, let's go ahead and allocate it. The other portion, we're just going to take the difference in this, because if we don't take the difference, there could be some items left over. Let's do this. There it is. Very straightforward, right? Once you know it, and then again, let's take a look at our total right here. 3,681 and 894. Yes, we are exactly where we want to be. You can see that on the order receipt, the total equals to what we're trying to allocate. So let's go ahead and allocate it right now. So again, $2,921.49. That includes shipping and handling. Would go towards furniture, and $760.45 will be expense. So let's go ahead and do that. Online market. Again, our objective with these simulations and just to show you the realistic scenarios of what you're going to face. Again, they are slightly simplified, but again, as we evolve with our simulation, they will get more and more complex. And you can see that this simulation is much more complex than the one that we had on Food Truck. And it will get much more complex as we progress. And then the other cool part, we'll actually do it on other platforms. We'll do it on Wave, we'll do it on XERO, we'll do it on Sage. Anyway, furniture. Furniture, $2,921.49. So here we have file cabinets. Next is office supplies, right? $760.45. Folders, green hanging folders, those are all supplies. Even though they may last us more than a year, those things, get replaced. So again, we allocated it. So let's go back to our debits and credits. What's happening here? So with purchases with debt, credit card. Credit cards is a debt, it's a liability, they go up when credited. So the whole amount, $3,681.94, increased our liability. What else happened? Well, it was twofold, right? We increased our furniture, which is an asset, right? We added to it. We bought some file cabinet. So assets go up when debited. What else happened? We bought some items that are more or less disposable office supplies. And in this case, we expense it. Again, debits and credits equal to each other. Account 64,900, that's our expense account goes up and it is debited. And our asset account for furniture goes up as well when debited. So here it is, ready to go. Let's go ahead and book it. Then we purchase some food items, all right? Because again, at the office, you want to have snacks, you want to have some water for the clients, you want to have some soda and water for the personnel that works there, right? If they want to have a drink, you don't want to be too cheap, you want to provide at least something. So here it is, right? We purchased some items from Food for You Mart. So let's go ahead and book it. All right. So all of this is technically office supplies. Again, we're not a food truck, we're not a restaurant, therefore there's no reason for us to classify it as anything else. It is for our office we're purchasing. Keep it simple. Okay, the whole amount would go towards that. And here we go, snacks and drinks. That's it, right? We just purchase some, we stock them. I'm sure you've been to professional offices before and they would offer you a drink and there'll be some snacks in a bowl that you can grab some candy. So that's what this is. Anyway, let's go ahead and book that. Oh, debits and credits. Before we do what? How do we do? How did we buy these items? We bought it with debt. So credit card is a liability. Liabilities go up when credited. And office supplies is an expense. Expenses go up when debited. Again, debits and credits have to equal each other in double entry accounting, and they do. Isn't that awesome? Here it is. All right. So let's go ahead and book it. Save and new. Next, we have Power Strip Surge Protector. All right. Will Power Protector serve us more than a year? Probably yes. Could we book it as an asset? Yes. But again, it's arguable. It's a period chip item. It's a call. In this instance, I would book it as office supplies. And again, maybe it won't last more than a year, right? Those things, questionable. Small enough amount. So again, this is where somebody would say, well, you could book it as an equipment. You could, but in this case, we don't have to and we won't. So again, let's go ahead. And again, we can go. All right, debits and credits. Very straightforward. Office supplies is an expense. Expenses go up when debited. What else is happening? We're financing this expense with debt, with our credit card. And That goes up when credited. Here it is. Debits and credits are in balance. Ready to book. Next one, we have some paper clips, binder clips, and crosscut off a shredder. Again, combination, right? The shredder is definitely a good piece of equipment that typically lasts us more than a year. It is expensive. Industrial shredders are very expensive. So we're going to capitalize this one, and we're going to expense this too. All right. What do we do with shipping and handling and taxes? We allocate it. We've done that before, so let's go ahead and do that again. Right here, we can use our previous one, so, right? So that's our top. Let's do that. 17 plus 120. Bottom is 2, 4, 5, 6. Here it is. There's our allocation. Let's do our shipping and handling. And let's see, what is this? That's our top, that's our bottom, that's what we're trying to allocate, correct. Okay, so let's go ahead and book it. Mark it, find the date. So again, we have some office supplies, right? Because those items, again, we may not use them all in a year, but again, there's such an insignificant, what we call immaterial amount that we can expense it. And then we have some furniture and equipment. This one is different from computer equipment, I want you to know. That's why we're not booking it into computer equipment, we're booking into furniture and equipment. And the main reason for that is depreciation. The timelines, if we do end up depreciating it instead of writing it off under bonus depreciation or section 179, in this case it will matter. So again, here we're going to write shredder. We have paper clips. Again, just for us to remember. All right, so here they are allocated. Let's go ahead and take a look at our debits and credits. Furniture and equipment, that's our shredders. Furniture and equipment goes up when debited. And then office supplies go up, again, when debited because it's an expense. Both assets and expenses go up when debited. Again, now the question is, how did we fund this purchase? We funded with credit card. Credit card is debt. Debt goes up when credited. So again, these two accounts here are debited. So these two amounts are debits to these accounts. And this amount here is a credit to this account. Right, and it's reflected here. Debits and credits have to equal each other, and on this interface we can see that they do. Have one more order receipt, and it's hand sanitizer and disposable masks, right? We all need those nowadays. Again, those are supplies. So, Clean Depot. Again, date is 15th. Reference number right here. And it's all office supplies, right? Again, these items ain't gonna go less than more than a year. It's very little amount, no brainer, expensive. How did we finance it? We finance it with a credit card. Credit card is a liability. Liabilities go up when credited. What else is happening? Well, we're basically expensed items. Expenses went up. Expenses go up when debited. Here it is, debits and credits equal to each other. This amount here is a debit to this account, and this amount here is a credit to this account. All right, and this is our last receipt for the credit card transactions, right? So we're going to have a save and close. and we have a return receipt to book, right? So what happened here is that some of those snacks were returned, right? I looked at it and I said, well, we bought way too many snacks. We're going to eat them. We don't want them to expire. And it's $15.80. And again, it ain't that much, but money is money. So again, let's go ahead and go back just to show you how do you book a refund from a credit card. Well, you go into credit card charges, right? And for those of you who watched Food Truck, you remember this. It's very straightforward. There's this little button that switches all these windows and in the way they behave in terms of debits and credits. So let's do that. All right. So here it is. Now it's credit card refund. It's from Food Mart. All right, and it's on 1/12/2021. All right, we're going to use the reference number, the amount. And this is office supplies. Again, no brainer, office supplies. And then food return, snack return. All right. Again, the main purpose, of course, to demonstrate how to book it, and it could be any other item. What's happening? Let's take a look at our credit card first. Well, we returned an item, and what did it do to our credit card balance? It reduced the amount of money we owe, right? Because again, we purchased something, our debt went up because we financed that purchase with a credit card, but now we returned that purchase. So technically, the amount of money we owe should go down, right? So how do we reduce debt? With debit. Here it is. What else is happening? Well, we purchased these items, our expenses on office supplies went up, but then we realized we don't need it, we returned it, so technically our expenses went down. We reduced our expenses. We thought we needed, we don't. Expenses are reduced when credited, right? When people ask, well, that's kind of the reason credit memo is called credit memo, and we'll get to those, right, in the next video. But in this case, with credit cards, they're called return receipts, and what they do is essentially, again, they debit for us internally our credit card balance, and therefore, again, credit card is a liability. When you debit it, the balance is reduced, so your level of debt is reduced, and your expenses are reduced too. All right, so here it is. Let's go ahead and book it. One more review. This amount right here is a credit to this account, this expense account. It reduced it, and then this amount here is a debit to this account, to this liability account, and it reduced that as well because liabilities are reduced when debited. All right, save and close. And that's it. We've done booking January credit card receipts and return receipts for our first month. Again, it was a lot. It was a good combination of equipment and expenses as we're setting up our office. The following months will be interesting as well, but the first one was definitely very diverse, right? Because again, as you set up an office, you have quite diversity of expenses and purchases and so on and so forth. Please again subscribe and stay tuned with our channel. We have a lot of interesting simulations for you. Thank you.